In the global financial markets, it is often the smallest shift in tone from a major central bank that shakes the entire world. And this week, the tremor came from Tokyo, my previous video, where I explained what's going on with the bond markets. And the Japanese yen did really well. It has over 200,000 views by now. Thank you to every single one of you who watched it. Today, we're going to build on that background, on the information that I shared in that video, and discuss the latest quite explosive economic data. What looked like an ordinary day turned into a drought for global bonds, after the Bank of Japan signaled for the first time in months that a rate hike could be coming in early December. For decades, Japan has been the outlier among advanced economies, keeping interest rates pinned near zero, even as the rest of the world tightened aggressively. But now Japan may be preparing to rejoin the global rate cycle, which will impact the United States economy directly, and in a minute I will explain how. So it started with a comment that was made by the governor of Bank of Japan, Kazuo Ueda, who suggested that the central bank would be reviewing the pros and the cons of lifting rates at its upcoming meeting, and that was all markets needed. Actually, in seconds after the comment was made, Japanese government bond yields surged. The two-year yield, which tends to snap quickly to any change in policy. Expectations broke above 1% for the first time since 2008. The 10-year yield climbed to 1.8%, nearly 9%, 1.9%. Both moves signal the same thing. Investors were preparing for the Bank of Japan's monetary policy shift that will have global implications, but the real story was how fast the shock actually spread across the rest of the world. Almost instantly, yields rose in Europe and in the United States. In the U.S., Treasury yields jumped by the most in a month. As traders pulled back expectations of deep rate cuts in 2026, the 10-year yield moved above 4% again, and the two-year rose to 3.5%. This is where the global picture becomes more interesting. In my opinion, higher yields in Japan matter because Japanese investors are among the biggest buyers of foreign government bonds, especially U.S. Treasuries and European sovereign debt. This is what I focused on in the first part to this video, in that first video that I mentioned. And if rates at home finally offer more compelling returns, what are those investors going to do? Well, of course, those investors will begin bringing their money back home. There is no other way around it. Either slowly reducing their purchases of overseas bonds, of U.S. bonds and European bonds, or repatriating funds outright. And this is very, very bad news for the United States and Europe, too, because that would remove a key source of demand at a moment. When Western governments are issuing enormous amounts of new debt to finance their operations, because they do operate at a deficit and they need the money, but it is about to get more expensive. Analysts described the market action as a butterfly effect, where a single hawkish signal in Tokyo tightened financial conditions globally, and for the United States, it didn't just raise near-term borrowing costs. It also dented expectations for aggressive 2026 rate cuts. In fact, U.S. futures markets now see only a few cuts next year, not the 6 or 7 or 8 that were predicted just a couple of weeks ago. The yen reacted just as forcefully, and this is also very important. After a month of weakness, the currency literally surged, nearly 1% against the dollar at one point. But this wasn't just a bond story. Stocks felt it too on Wall Street. Tech shares led the pullback. Both the NASDAQ and the S&P 500 slipped into the red as investors sold off riskier positions. Part of that weakness came from another surprising source from Bitcoin. And I will briefly comment on this. The cryptocurrency was down 7% on the day, and its month-long slide has now erased more than 20% of its value. It is a very, very volatile asset. Strategists noted that in recent months, crypto and high-growth equities, high-growth stocks, in other words, have become tightly correlated, which is quite unusual, and when one drops, the other tends to follow. And at the same time as all of this is unfolding, there is another major development: the growing likelihood of a Federal Reserve rate cut in December. Markets now priced in an 88% chance that the Fed will trim rates by a quarter point at its meeting next week, but beyond December, the path becomes much hazier, and there is so much uncertainty. As you know, the possibility of a new Fed chair has made a big impact on market expectations, too. There is going to be a whole new video on my channel about the new Fed chair, so make sure that you're staying tuned if you're interested. Now, how do these things impact the dollar? That is the big question, too. That uncertainty that I just described is definitely weighing on the dollar, on its value when you combine a fading rate advantage with expectations that the Fed chair could soon be replaced. You get a currency that has just had its worst week in 4 months. Underneath all of this are signs that the U.S. economy is losing some steam again. New data showed manufacturing actually contracted for a 9th straight month. So for 3 quarters now, it has contracted so much for reindustrialization, right? The euro and British pound both gain ground against the dollar. So that is another thing to consider when you look at this year and the performance of the dollar overall. So this week, the spotlight is fully back on monetary policy, and I expect next week to be the same. Also, we have to factor in Japan's potential hike and its implications on global markets, the Fed's likely cut, and the increasingly volatile situation between currencies. Bonds and equities around the world, all of this sets up a December that will be filled with high-stakes decisions that will ripple far into early 2026. And beyond, the Bank of Japan could end decades of ultra-easy policy. The Fed could confirm its rate cut, and investors could get more clarity on who will succeed. Jerome Powell for now, though. The message from the markets is very simple. When Japan moves, global economies react very quickly. So this is definitely something to be aware of. I will keep you updated on the recent developments over on my Substack and my Patreon. Thank you so much for joining me. I truly appreciate your time. Remember to like, subscribe, and share my content. I appreciate every single one of you who has become a paid subscriber on YouTube. Substack and Patreon, thank you so much for your support. And I will see you back here tomorrow. Bye for now.